public sector balance sheet comprises the assets and liabilities held by all central, devolved, and local government bodies, and the public corporations they own or control. A target for some measure of the government balance sheet has been included in almost every UK fiscal framework since 1997. In October 2024, the government announced it would target the more comprehensive measure of public sector net financial liabilities, or PSNUFL, which includes all financial assets and all liabilities recognised in the national accounts. Over the past 2 decades, the size and complexity of the government's financial balance sheet has expanded considerably. Net financial liabilities have more than doubled from 33% to 83% of GDP. This has been driven by the rise in public sector debt, which has nearly tripled from 33% of GDP to 96%. Slightly offsetting this has been an 8% of GDP rise in loan assets, with everything else, largely the assets and liabilities of funded pensions, roughly balancing out. Targeting PSNUFL, as opposed to the previously targeted public sector net debt measure, brings with it greater focus on the management of the wider set of financial assets and liabilities that it covers. But it also creates new fiscal risks, which are explored in a chapter of our 2025 Fiscal Risks and Sustainability Report. Firstly, we assess the risks to meeting the government's new fiscal target that can arise from changes in the valuation of financial assets and liabilities held on the government balance sheet. These are explored by modelling a series of shocks, including a 1 percentage point reduction in the discount rates affecting the value of funded public sector pension liabilities, a 10% fall in the market value of equity assets held by funded public sector pension schemes and other public bodies, and a 30% decrease in the value of central government loan assets, excluding student loans. Individually, these shocks raise the level of PSNUFL as a share of GDP by a percentage point or more, which remains above the baseline throughout the forecast period. But because the government's fiscal target is to have PSNUFL falling as a share of GDP in the later years of the forecast, this rule is still met in all cases. In addition to the risks arising from assets and liabilities on the public balance sheet, there are also risks associated with near-public sector bodies, which are currently classified to the private sector, but could be reclassified into the public sector by the Office for National Statistics. Our analysis covers 3 sectors: water companies, where reclassification to the public sector would increase PSNUFL by around £78 billion, housing associations, where reclassification would increase PSNUFL by around £99 billion, and higher education institutions, where reclassification would reduce PSNUFL by around £8 billion. Reclassification of some of these bodies would adversely impact PSNUFL. This is partly because their holdings of fixed assets, such as water networks and housing stocks, are not recognised in the measure. A final source of risk to PSNUFL is associated with contingent liabilities, which is where the government faces fiscal costs only if a particular event were to occur in the future. These are estimated to represent a total risk of around £250 billion, or just under 9% of GDP. However, the bulk of these are long-term, especially those related to nuclear decommissioning, and are most likely to crystallise beyond the next 30 years. Only around £16 billion are expected to crystallise over the next 5 years. Read the full report on our website at www.obr.uk.